Imagine you're sitting across from a loan officer. You've done everything right. You have a steady job, you've never missed a bill, you've been responsible with money your whole adult life. And then they slide a number across the table, your credit score, and it's not what you expected. It's lower than it should be. And suddenly, this number, this one 3-digit number, is deciding whether you get the house, the car, the loan, whether your life moves forward or stays stuck. And the worst part? Nobody told you why it's low. Nobody handed you a rule book. You were just supposed to know. Hi, I'm Tom, and today we're talking about credit scores. Specifically, the part of the system that almost nobody explains to you. The part that, once you understand it, makes you realize the game was slightly rigged from the start. Not in a scary conspiracy way, just in a "why did nobody tell me this earlier" kind of way. Most people think credit scores are a straightforward measure of how responsible you are with money. Pay your bills on time, score goes up. Miss a payment, score goes down. Simple, right? And that's exactly what the system wants you to think. Because the moment you believe it's that simple, you stop asking questions. You accept the number. You feel either proud or ashamed of it, and either way, you stop digging. But here's the thing. Credit scoring models, the ones used by FICO, which powers about 90% of lending decisions in the United States, are not purely about responsibility. They're about profitability. The score is designed to predict how likely you are to repay a loan in a way that's useful to a lender, not how good you are with money, not how financially mature you are, how useful you are as a borrowing customer. That's a subtle but massive difference. And once you see it through that lens, a lot of things start making sense. Like why someone who's never had debt in their life can have a lower credit score than someone who's been in debt for 20 years. Or why closing a credit card you don't use can actually hurt your score. Or why carrying a small balance used to be considered smart, even though financially it costs you money. None of that sounds like a responsibility score to me. It sounds like a system that rewards a very specific kind of behavior, and if you don't know what that behavior is, you're essentially playing a game without knowing the rules. So let's talk about the rules. Your FICO credit score is calculated using 5 main factors, and I want to walk through them, not like a textbook, but like a conversation, because the details here are where everything gets interesting. The biggest piece, about 35% of your score, is payment history. This one actually is what people think it is. Pay on time, it helps. Miss a payment, it hurts. A 30-day late payment can drop your score significantly, and it can stay on your report for up to 7 years. So this part is straightforward. But it's the next piece where things get complicated. The second factor is credit utilization. It makes up about 30% of your score, and this is where most people, even financially responsible people, quietly lose points without realizing it. Credit utilization is the ratio of how much credit you're using versus how much you have available. So if you have a credit card with a $10,000 limit and you've charged $3,000 on it, your utilization on that card is 30%. Now, most people have heard keep your utilization under 30%. And that sounds reasonable, but what the banks don't loudly advertise is that the sweet spot for a truly excellent score is actually below 10%. Some financial analysts suggest even below 7% for maximum optimization. Think about what that means practically. If your only credit card has a $5,000 limit, you'd need to keep your balance under $500, not $1,500, to hit that elite tier. For most people living their actual lives, that's not how they use a credit card. They use it for groceries, gas, subscriptions, maybe a flight. They pay it off every month, they think they're doing great, and they might still be sitting at 28% utilization, getting quietly penalized for it. And here's the part that really gets me. Utilization is calculated at a specific moment, usually when your statement closes, not when you pay it off. So even if you pay your card in full every single month, if your balance is high on the statement closing date, the bureaus see that high utilization and score you accordingly. This is the loophole,
Or really, it's the gap in understanding that costs people points every single month without them knowing it. The fix, once you know it, is almost embarrassingly simple. Pay your credit card balance before your statement closes, not just before the due date. Or make 2 payments a month, one mid-cycle, one at the end. That way, the balance reported to the bureaus stays low and your utilization looks excellent even if you're spending normally. That one adjustment, paying a week earlier than you thought you needed to, can meaningfully move your credit score over time, without spending differently, without taking on or paying off debt. Just timing. Now let's talk about the third factor, length of credit history, about 15% of your score. And this one has a trap that catches a lot of people who are actually trying to do the right thing. When you close a credit card, maybe because you got a better one or you're trying to simplify your finances, you might think you're cleaning up, being responsible, but what you're actually doing is potentially shrinking your average account age, because that old card, even if you hadn't touched it in years, was pulling your average credit age up. Take it away, and suddenly your score takes a hit. I've seen people try to close their oldest credit card, the one from college with the embarrassing $500 limit, and watch their score drop 20 to 30 points. Not because they did anything wrong, because they didn't understand that even dormant accounts have value in this system. The fourth and fifth factors, credit mix and new inquiries, matter less, but they're worth understanding briefly. Credit mix just means the system likes to see that you can handle different types of credit, a credit card, a car loan, a mortgage. It sees variety as proof of competence. New inquiries refers to hard pulls on your credit. Every time you apply for a new card or loan, it can ding your score slightly, typically for about a year. So the picture that emerges isn't just be responsible, it's much more specific than that. The system rewards people who use credit consistently, keep balances low relative to limits, maintain old accounts, carry a mix of debt types, and don't open too many new accounts too quickly. That's a very particular profile, and if your life doesn't naturally match that profile, your score suffers, regardless of how carefully you manage your actual money. Here's the mindset shift that changed how I think about all of this. Your credit score isn't a measure of your financial character. It's a measure of how well you play a specific game, and games can be learned. The moment I stopped feeling judged by my credit score and started seeing it as a system with rules I could understand and work with, everything changed. Not my spending, not my income, just my relationship to the number. Because a lot of the anxiety people feel around credit scores comes from treating it like a verdict, like some institution looked at your life and decided how worthy you are. And that feeling, that shame or pride, makes people either avoid looking at their credit altogether or become obsessed with it in an unhealthy way. But it's neither a verdict nor a mystery. It's a formula, and formulas respond to inputs. The psychological weight of this matters more than people realize. When someone believes their credit score is out of their control, something that just happens to them, they disengage. They don't check their report. They don't notice errors. They don't make small strategic adjustments. And the score stays mediocre, not because their financial behavior is bad, but because they've mentally given up ownership of it. Studies on financial behavior consistently show that people who feel a sense of agency over their money, even imperfect agency, make better decisions than people who feel powerless. This isn't about willpower or discipline. It's about believing the game is playable. And it is. That's what I want you to take away from this.
So, what do you actually do with all of this? First, get your free credit report from annualcreditreport.com. That's the official one, not the ones that charge you hidden fees. Look at it, not to panic, just to understand what's on it. Errors on credit reports are more common than most people think, and a single outdated account or misreported late payment can drag your score down for years. You have the legal right to dispute anything inaccurate. Second, figure out your statement closing dates for each of your credit cards. This is usually visible in your online account. Then, start timing your payments differently.
Pay down your balance a few days before that closing date, not just before the due date. Even one card optimized this way can make a noticeable difference in your reported utilization. Third, resist the urge to close old credit cards you're not using, unless there's a compelling reason, like an annual fee that isn't worth it. If the card has no fee, keep it open, even if you use it once every few months for a small purchase, just to keep it active. The length of that history is quietly working in your favor. Fourth, and this one's simple but powerful, if you have a card with a low credit limit, consider calling the issuer and requesting a credit limit increase. You don't have to spend more, you just have more available credit, which automatically lowers your utilization ratio. Many issuers will do this without a hard pull on your credit, especially if you've had the card for a year or more and paid on time. You can literally improve your credit score without changing any financial behavior, just by making a phone call. And finally, if you don't have any credit history at all, maybe you're just starting out, or you went through a period of avoiding credit entirely, a secured credit card or a credit builder loan from a credit union can start the process gently. These aren't traps, they're on-ramps. You put down a small deposit, use the card carefully, pay it on time, and the bureaus start to see you. It takes patience, but it works. None of these things require you to be wealthy. None of them require a financial advisor. They just require knowing the rules of the game, which, as we've established, nobody really teaches you. I want to end with something that I think gets lost in most financial content. The credit score system is imperfect. It was built by financial institutions to serve financial institutions, and for a long time it's been used in ways that make it harder for the people who most need access to credit to get it, and easier for the people who already have financial stability to accumulate more. That's a real conversation worth having, and knowing that the system has flaws doesn't mean you have to play by rules you find unfair. But while that bigger conversation is happening, and it is happening, you still have to live your life. You still need to rent apartments, finance cars, maybe buy a house someday. And in that world, your credit score is a real thing with real consequences. So understanding it isn't selling out. It's not pretending the system is fair. It's just being informed. It's choosing not to let a formula you didn't design quietly limit your options because nobody explained it to you. You're not behind. You're just not supposed to know this stuff. The fact that you're watching this, that you're asking these questions, that you care enough to understand the thing before it affects you, that already puts you ahead of where most people are. Progress beats perfection, and in this case, even a small improvement in your credit profile can open a door that previously felt closed. That matters. You matter. And you've got this. If this helped you, share it with someone who's never had anyone explain credit to them properly, because that's most of us. I'll see you in the next one.